Thank you to the panelists for being here. The global economy, as usual, it's the topic of conversation at these meetings here at the IMF. And I'm hearing quite a few concerning things. So, I want to see if you guys are on the same page as most people, quite bearish, or, if you have some reasons to be a bit more optimistic. So let's jump straight into the questions. Janet, let's start with you and precisely on this issue of the global economy, manufacturing not doing very well, people very focused on the data points that don't look good, emphasizing less the good ones, as in, well, there may be spillover soon, so the good stuff may be gone. How do you see it?
Well, the global economy is certainly slowing down, and I suppose the most well-used term this week at these meetings has been about the synchronized slowdown, because obviously all regions are participating in it. And so even though globally, we're already almost as weak as we were back in 2012, then a lot of it was the Eurozone story. So yes, there are some glimmers of hope in some of the purchasing manager surveys, particularly for some of the key sectors. Obviously we live in a very technologically advanced age, and there are lots of things to be excited about regarding the new economy. So, I don't want to put too much emphasis on things like the auto sector and also the tech sectors, but those are two big sectors that really have contributed to quite a deep global industrial recession, and some of those are fading. The contractions are fading, and, the PMI's electronics sector is starting to turn. But to some degree, that is looking through the rearview mirror, because we know that we are in a world where, yes, financial markets respond to every headline on trade developments, phase one deal, step to a future deal, but the world has changed, and the pressures towards deglobalization are with us for the foreseeable future, even if there are some trade liberalizations still happening, and that's a world where investment spending is going to remain very weak, and we are heading towards, at a minimum, a further slowdown, if not something worse.
Mm-hmm. Pascal, similar question, but maybe a bit more from the angle of, given all these risks, how much do you think markets are actually pricing high risk of recession and people are gearing portfolios toward that, or not so much? It's lots of headlines, but S&P 500 is still quite okay. How do you see the global picture and what investors are doing?
Yeah, in the last 2 years, returns have been driven by a single factor. Let's call it the interest rate factor in relation to inflationary expectations, first downward and then upward, the perfect mirror effect, 2018, 2019. We are moving into a phase with more dispersion of potential outcomes. My view is the following one. I think that fears about a global recession are overdone. For sure, we are slowing down on the manufacturing side of the equation, but the strength of the consumer of services is underestimated to a large extent. And this leads me to think that too much is expected in the markets from both monetary policy and budgetary action at this point. There is room for disappointment. In terms of expectations, to an extent, recession is already priced to a large extent into some market segments. Just look at the curves on the bond side, some defensive sectors on the equity side. And looking at volatility as an asset class, it has been constrained quite a lot by QEs, by carry strategies. They are sellers of volatility. But more recently, we've seen implied volatility in the markets picking up, showing that there is some demand for protection. And more fundamentally, actually, and this goes beyond the trade noise we are all talking about, what I think is that global growth is not falling off the cliff. What's going on is structural change in the structure of global growth. Global growth is retreating back home, closer to regional, domestic type of dynamics, closer to the consumer, to services. And this has profound implications for investors like us, because we've been long global trade in the last 2 decades. One way or the other, our portfolios have been correlated to the global trade factor. So we are moving into a phase where we should see more diversification again across the globe, given this retreat from the globalization first phase, I would say.
So there's actually a question from the audience that I think relates a lot to what you were just saying on, how trade, like we all won a lot from trade, but this may be changing. And the question is, in this environment that looks quite different, is there something we can say in terms of EM versus DM growth, being clearly better in one place or the other? I mean, I can think off the top of my head that many EMs grew out of exporting, and that some advanced economies are more closed, they're bigger. But I don't know if this can really drive medium-term growth. Any views on the panel?
Yeah, I'm happy to comment on that one. I mean, it's interesting. You're right. A lot of emerging economies did grow out of export-led growth, and particularly some of the Asian countries. As much as we talk about much higher growth potential in the emerging world rather than the advanced world, there aren't many emerging economies that have really escaped the middle income trap. Most of those that have been in East Asia. And that's the model that's been followed. But it's interesting when you look at our forecasts for 2020 and 2021, and also the countries where we've made the continued and bigger downward revisions to growth, it's quite clear. The countries that we've been cutting our numbers for have been mainly in Europe and particularly in Germany. We've also cut our China numbers, but it's still, 5.8% growth where we are for next year is still pretty good in that world. But the ones where we've got relative outperformance are in some of the emerging economies. It's somewhere like, for instance, the Philippines, maybe even a little bit in Indonesia, countries where there is, or even Malaysia, countries where there's scope to deliver a domestic policy stimulus and where there is already, it's being delivered, and where there is more in the way of domestic dynamism. And Poland is another one. So some of these countries are countries where we see them having both a structure of an economy and the policy stimulus to mean that, relatively speaking, at a minimum, they will outperform in this slowing growth world.
Mm-hmm. Perfect. Rebecca, another very important piece of the puzzle. In these conditions, it's no surprise that central banks are easing. Some have a harder time finding ways to do it than others, but they are definitely trying. And then, so there's a lot of debate on, well, we've seen this many times in the last 10 years. Does it still work? Will we, this time around, can we still grow out of central bank easing? Or do we need something else? Should we be focusing on something completely different?
It is extraordinary on one level that you have so many central banks around the world easing now. I mean, it's up to probably 36 or so central banks that are in easing mode. And obviously having lower rates, lower borrowing costs for households and businesses has to have a positive impact. But the question is how much? What will the transmission vehicle be? And in the United States, you have seen this year, thanks to falling yields, mortgage rates have come down by 100 basis points. And you are seeing that a little bit in the housing data. So we had housing sentiment data this last week or so, that it was at its highest level since February 2018, and that bodes well for actual housing starts going forward. So there is something happening that's good. But at this point in the cycle, if rates go down 25, 50 basis points, if you already bought your car, are you going to buy a new one? I think the consumer channel and housing is probably the main channel where we're seeing it. I think, though, if you go outside the U.S., and you highlighted this, that the transmission channel is getting more and more difficult or more clogged up. The pipes aren't working as well. And I spend a lot of time thinking about the banking sectors in particular for Europe and Japan. In Europe, the banking sector financials are about 17% of the Euro Stoxx index, and we aren't seeing the banks benefiting from lower rates. Bank stocks tend to lag the overall equity market for both countries and have done for some time. And without banks being robust and healthy and lending, it's very hard to see the markets go up broadly. It's very hard to see that positive feedback loop from asset prices to the economy. So in Europe's case, I think they are running out of bullets despite their efforts to convince us otherwise. And in Japan's case, I think they're done. There's a lot of discussion, should we have more easing towards the end of this year in Japan, but they don't want the long end of the curve to fall too much. When I was in Tokyo earlier this year speaking to policymakers, the feedback I got was, we'll probably end up just buying more ETFs. Well, Japanese stocks haven't benefited too much from that BOJ effort, and foreigners until very recently have been selling. So I'm questioning if 2 of the 3 big central banks here are not getting that transmission channel. Even if you have a lot of central banks in aggregate, how much lift are we going to get? Some, but I don't think as much as we would have a decade ago.
Mm-hmm. That's indeed something we've heard these days. And Joachim, you've written about all these things. You've called it a window of weakness. Can you explain to us the meaning of the term, and how much can central banks close this window of weakness? Or is it a bit like Rebecca is saying that, yes, here there may be something in housing going on in response to lower rates, but that globally you have so much GDP that is tied to monetary policy that it's just running out of steam? How do you see it?
Yeah, so what does window of weakness mean? Well, we think the global economy has entered a window of weakness, a period of very weak growth. Actually, we see growth slowing further over the next few quarters because the US is lagging behind a little bit. The US had a special effect last year from fiscal policy, has now been catching down to the rest of the world, and the momentum in the US is still lower. So we have entered this window of weakness where growth slows to something like stall speed. And if you're at stall speed, it doesn't take much to tip you over. Mm-hmm. So I'm not that encouraged by the signs of stabilization that we see in some of the PMIs in China, in emerging markets, mainly because I think the US is still on its way towards something like 1% growth in the first half of next year. So what about monetary policy? Well, the question is, why are we slowing? I mean, obviously, we've had the trade conflict that had an impact, but I think what we've been seeing this year is that monetary policy still has a strong impact, a strong effect on the real economy. Because last year, the Fed was tightening. And the Fed is really the driver of the global liquidity, of the global credit cycle. The Fed hiked rates 4 times. The Fed probably went above neutral in the course of last year. They found that out in the 4th quarter when asset markets reacted. Let's not forget the ECB ended QE not so long ago. So I think what you're seeing in the course of this year, the slowdown in the economy, is really a lagged effect. To a large extent, it's a lagged effect of past monetary tightening. And now we still live in this period where the time lags are working. And yes, we've seen monetary easing in the course of this year. The Fed has already delivered some. So eventually that should lead to some stabilization. But I think it's extremely important, and this gets to a point that Pascal earlier mentioned, the markets are priced for further easing from the Fed. Mm-hmm. And I think it's extremely important that the Fed delivers the 2 or 3 more rate hikes, because if it doesn't, then I think equity markets and other risk assets are in for a correction, and that could actually then be the thing that tips the real economy over.
Mm-hmm. So I think we are on an interesting topic, judging from the number of questions coming in. A bunch of things on monetary policy that I think are important. So let's maybe go over a few of them. Let's maybe first, one that I think matters a lot for many of our members, for banks especially, which is negative interest rates. Do they work? Are we creating a problem? Or no, in net terms, it's better than doing nothing else? How do you see it? That's not an issue in the US, clearly, but Europe, Japan, it looks like they're going to live with the negative rates for some time.
Well, have they worked? It depends on what you look at. So if you look at the euro area, I think negative rates were very effective in accelerating the impact or magnifying the impact of QE. What did the ECB want to do? They wanted investors to move along the curve, both the risk-free curve and push down yields across the curve. They wanted investors to move out on the risk curve, in the hope that this would stimulate the economy. And they also wanted to provide an incentive for banks to try to get rid of the excess reserves. As a system overall, you cannot do that because the system is closed, but each individual bank can try to do that. And if you look at what's happened to bank lending in the euro area over the past few years since the ECB introduced negative interest rates, bank lending has actually been accelerating. So in that respect, it's been working, I would say. But of course, we all know about the negative side effects, and the longer you keep rates negative, the larger these negative side effects become. There is something like a reversal rate, where that exactly is nobody knows, but a reversal rate at which the negative effects of negative rates outweigh the positive effects. Mm-hmm. I don't think we're quite there yet, particularly as the ECB has introduced tiering, which alleviates the pressure for banks a little bit. So I think it's a question of how long you stay with negative rates. If you make this perpetual, it eventually becomes a problem. But I don't think we're at that stage quite yet.
Mm-hmm. Pascal?
Yeah, one of the biggest developments for me, actually, moving forward is this ongoing regime shift, where we will see more and more politicization of monetary variables, and symmetrically a sort of monetization of the budgetary debate. And at the end of the journey, my view is that at the next recession, we will be more, not less, aggressive action, non-orthodox action coming from both sides. In that sense, basically, the Volcker period is coming to an end. And this has some implications. Coming to the negative interest rate policy or loose monetary policies have produced positive impacts, actually. In Europe, it has helped basically breaking the fragmentation of the market, the bond markets, typically reviving the credit channel. So it's a plus. We are obviously moving into territories where marginal utility and efficiencies are falling off the cliff, probably, and this is part of the dissensus we've been seeing in Europe recently at the ECB, and this will probably be the key mission of Ms. Lagarde at the ECB. Actually, the good news about the dissensus at the ECB is that it has sent a message to the markets about expectations. Too much was expected, and expectations are in the process of being revised. Having said that, consensus has to be rebuilt. It will take some time. And the second mission is to bridge the gap between the monetary side and the budgetary side of the policy mix in Europe. And the DNA and profile of Ms. Lagarde is particularly appropriate to bridge this gap.
Mm-hmm. If I could jump in just kind of on second and third derivative of this, to the degree we have negative rates lower and longer, whether it's Japan, Europe, it's having a lot of global effects. We definitely see the flows coming from those places to the United States, pushing the U.S. yield curve down at the long end. Part of the inversion we had recently seems to be a reflection of that. The problem is it has the same effect on a lot of investor sentiment, even if it's for the wrong reason, right? It's not necessarily just reflecting domestic developments in the United States. It's also reflecting foreign capital flows, but people freak out just the same if they turn on the TV. So that would be one issue. You get a lot of money going into credit products, credit strategies that perhaps don't have the liquidity, or perhaps people don't understand the risks they're taking. And then obviously we heard at lunch from James Gorman, Jamie Dimon, about what's going on with public versus private securities. The 2.5 is one estimate I read, $1 trillion of dry powder that private equity has today, in part, is a reflection of negative rates. If you can't get the return you used to get from yield, especially if you're a pension fund or an endowment or a foundation, you're forced to go out either on the credit curve or on the duration curve, and private equity is a version of that. I worry a lot that you're going to have some investors, institutional and retail, taking risks that when we go from a weak period to a recession or a crisis period, they're going to only realize what they have then. And they're going to have liquidity issues as well as return issues that could evolve in ways that we don't really expect right now.
Mm-hmm. So you mentioned the yield curve briefly. Given how much we've played with it in the last 8 years in all kinds of crazy ways, do we have to de-emphasize it as a signal of upcoming economic trouble, or should we really pay attention to it and it is it is an advance warning of something.
I mean, the Fed would love us to ignore it. That would make them so happy. Historically, it's been a consistent predictor, which is why everyone talks about it and focuses on it. But we know the world is very different today. Bond markets globally, and Joachim is the better person, given where he works, to talk about bond markets. So I'll keep it short, and maybe you can jump in. But bond markets have been so globalized that what drives the yield curve today is just structurally different than what it was 10 or 20 years ago. So we do have to take that into account when we see the curve and what's happening, but you also don't want to ignore how the average investor reacts and what that could do in terms of spillover effects.
Mm-hmm.
I think it's always dangerous to say this time is different, right? And I think central banks, particularly the Fed, ignore the yield curve at their own peril. There were a lot of people around back in the mid-2000s, including Ben Bernanke, who said, well, the inversion of the yield curve in 2006, early 2006, didn't really matter because it was caused by the global saving glut, right? And now the story is, well, it's negative yields elsewhere in the world that are dragging down the long end. The term premium has become negative, so why worry? And, some people say you have to adjust the yield curve for that negative term premium. Yeah. I think that's a very dangerous thing because you have to think about why is a negative yield curve, why has it been a good predictor of recession? It's not that bond investors are so smart in forecasting the recession. It's rather because when the yield curve is inverted, it creates a huge disincentive for the banking sector and for the financial system to churn credit, to create credit, right? Because most of these financial institutions still borrow short and they lend long. So it doesn't really matter why the yield curve is inverted. If it's inverted, you get that disincentive, and obviously, there are time lags involved, but that's why I think it's an important signal. And I actually think the Fed, at least the leadership at the Fed, takes the signal seriously. And so they are keen, and actually they have just managed to disinvert the yield curve. Mm-hmm. And I think they want to go further and buy some more insurance. So that's why I think we'll see a couple more rate cuts at least.
Yeah, but very important point on causation.
I was going to say, you make the point that it was all about the global savings glut, but to some degree, it still is about the global savings glut. We're focusing, and all the discussion so far has all been about monetary policy and what monetary policy can do and credit creation. And even the point about negative interest rates, working and adding to credit creation, yes, it has in France and Germany, but it hasn't in large other parts of the Eurozone, where there's been very little in the way of credit creation. And when the big shock, I completely agree with you, Joachim, that over the last year or so, the Fed tightening played a very key role. But the big threat going forward is the trade uncertainty and the uncertainty related to investment spending, that companies aren't going to start investing again. So if you've got this glut of savings, because corporates are savings rather than investing, even household savings rates have been rising over the last year, even across Europe, you're back to that global savings glut. The interest rate that balances that large amount of global savings with the very shortage of desired investment is going to be a sustainably low interest rate. So while monetary policy can, yes, keep the expansion growing, we're all talking about a world where asset bubbles are going to continue to grow. Mm-hmm. The consequence of this is going to be bigger asset bubbles in the coming years, a harder landing at some point, and even more difficulty meeting unrealistic inflation targets if we do not have a change in the mix of policy.
Now you got me worried.
The problem with negative interest rates is that at some point this turns a pure monetary thing into a political matter, actually, because at the end of the day, you end up eating the savings pool, the life insurance policies, the pensioner, so basically the man in the street. And this is not yet obvious, but it's coming reasonably fast. In the next sequence. The second comment actually is the false sense of excess of liquidity. Yes, we are living in a world of excess of liquidity in the macro sense, looking at balance sheets of central banks typically, but at the market level, we've seen a deterioration in market liquidity as the legacy of the crisis. The crisis led banks to retreat from market-making operations, and at the same time, we've seen a frantic search for yield from investors backed by various QEs across the globe. So those are the ingredients of a potential liquidity mismatch at the fund level, at least. And this is one of the top risks I've got in mind moving into next year, actually, where, how can I say, yes, banks are less risky, but risks have just been shifted elsewhere in the system, on the buy side, specifically asset owners, asset managers, insurers. And this liquidity thing, actually market liquidity, is potentially a channel from the last crisis to the next one.
Mm-hmm. Let me pick one more question related to monetary policy, and then we do move on to many of the other issues that matter. Repo market dislocations, microstructure and something we shouldn't worry too much about, or macro relevant, a signal that there's something in the plumbing of the system that is not working, something that the Fed should do differently, and it matters in the big picture. What do you guys think?
I don't think it's a market, a macro worry. I mean, obviously, if this had persisted, if the Fed had not reacted, then it would have created problems, because the repo market is incredibly important for financing all kinds of financial activity. But I think this is, I guess the source for this is really regulation, and the Fed did not have full transparency on what the real liquidity needs of the banking system were. But they've now addressed it, and they've addressed it relatively early, right? It took them some time, it took the New York Fed some time. The FOMC has now reacted. They are buying T-bills at a fairly fast clip. So I don't think this is a monetary or a macro issue. And I also don't think, there are some people who say, well, now they are doing QE again, right? In a technical sense, it's right, they are lengthening their balance sheet, but this is very different from large-scale asset purchases where you take duration out of the market. This is not what the Fed is doing here. So I don't think this tells us anything about the future course of interest rate policy, right? The fact that they're now buying T-bills should not make them less willing to cut interest rates. And I think that that's exactly how the Fed looks at it.
If I can pick up on Joachim, you mentioned regulatory, and there's other parts of the regulatory story. Again, at lunch, we were talking a little bit about CCAR and CLAR. Since the crisis, there are more and more capital requirements that banks are required to meet in the United States and elsewhere before year end. And there are tests that are done around year end. And when people look at the veracity of the sell-off that we had in Q4 last year, and especially December, there's some emphasis put on the fact that maybe the banks were pulling in their reins, not providing the normal liquidity because of these tests, and that might have had an influence on the sell-off. What I'm hearing anecdotally now is that as we get in towards year end, we could see some of that same change in liquidity conditions. So it's totally separate from repo, but it's similar in that both of them are caused, at least in part, by regulatory changes and requirements of the banks. It doesn't mean we're going to have a sell-off at the end of the year. I think that's a completely separate question. But it does mean one needs to be very cognizant that liquidity conditions probably will deteriorate towards year end, and maybe more than you might expect now that the Fed is easing. You still might see it for these other separate causes.
Yeah, related or not to this repo rate thing, I've not yet met someone basically explaining convincingly to me what happened, actually. When the repo rate of the biggest central bank hits 10% or more, actually there is something going on, actually. It's a fact. So, related or not, actually, one of the top risks I'm seeing moving forward related to market structure is the shrinkage of the global liquidity dollar base, actually, as a combination of various forces, the retreat from the decrease in the euro-dollar operations, what's going on related to protectionism is another aspect. Actually, the dollar and the US deficits have been instrumental to lubricating global trade. So it doesn't tell much about the direction of the currency for the dollar, but it may lead to some disruptions, spikes in volatility, moving forward.
So let me switch gears to something really important, and in fact it was the most chosen option in the polling question, not surprisingly I would say, which is trade tensions. And Janet, before we talk about the negotiations themselves and tariffs, China, in terms of growth, it slowed further. The data we got last night shows, as before, smoothly declining growth. Other domestic indicators have looked weaker than that for some time. What is happening in China, and are policymakers stimulating as much as they did in 15-16, less? Why? What's happening there?
Well, it's clear that they're not stimulating as much or as quickly as they did back in 2015, or indeed certainly back in 2010. And they face, a different challenge this time. So, what you had from 2012 to 2015 was a kind of 3-year slowdown in China. They were trying to slow growth down, then it slowed too much, and then you had that massive stimulus. Then they switched from the beginning of 2018, when the economy started the year almost growing too strongly. And we need to remember the initial slowdown in China was policy induced. And now it has slowed by more than they had expected. But also what has changed is their willingness to accept slower growth than we previously thought the case was six months ago. So, we think that they will become a bit more aggressive, speed up what they're doing, but it will still be about managing the slowdown rather than stimulating a massive increase in demand. They are still worried about leverage in the system. They're particularly worried that the property sector is still so strong. When you look at the breakdown of investment spending, it's property and construction, which is still the strongest. The weakness is on manufacturing and private investment, which is being weighed down by trade tensions, and they're starting to step up a little bit more on the infrastructure spending. But it's not going to go back to 20%. It might go up to 5 to 10%. So I think they'll become gradually a little bit more aggressive on the policy front, particularly in 2020, if inflation continues to slow. Headline inflation's being held up by food prices. PPI's already turned negative. If it looks like there's more of a deflationary threat going through 2020, I think they will become a bit more aggressive. But it's a different mix. In China, it is happening on investment as not all overburdening monetary policy and not just supporting consumer spending, about supporting other areas of investment.
Mm-hmm. How big will the global implications of this different approach in China be? Like, was China essential to lift the world out of this period of bad manufacturing growth in 15-16? Or can things still improve even if China is more prudent, let's say, now?
It can, but it will be different countries that improve, and domestic policies will matter more. Countries that are much, much more dependent on global demand, with very little in the way of domestic demand or ability or willingness to deliver a domestic policy stimulus, are going to be more affected. It's interesting, if you look at, the takeoff in Germany in 2016, 2017, a huge amount of that was driven by China. Without China, as long as China stabilizes, and particularly if US growth does stabilize, we can still get some global growth. But those countries that are very dependent on the world trade story are still going to consistently underperform. Mm-hmm. Europe particularly.
Joachim, still on the China theme, trade, we may get a partial deal, phase one, let's call it partial, or not. But we seem to be coming closer to it. Can we expect something long-lasting? Will markets and the global economy benefit durably from some agreement, or should we be thinking, no, it's going to be more of what we've seen in the last year and a half?
Well, I would look at this as a truce. This is not a major de-escalation of the conflict. It just stops a further escalation for now, until the next tweet, who knows. So I don't think this is a lasting solution. And I don't think this will lead to a massive rebound in corporate investment just because, we agree to, China agrees to buy some more soybeans and we we do not increase tariffs, at least not the October round. So I think there's a much deeper conflict at work between the US and China. I think that's well known. There is a dominant global power, the US, that feels challenged, and rightly feels challenged by the rising economic power. And the US is pushing back on that. So I think we're in a new Cold War, and this is really about technological race for technological leadership, technological superiority. So I think this will remain. So I think trade is just one manifestation of this conflict. And I think we have to get used to the idea, and companies and investors have to get used to the idea that we have moved from the super secular trend of globalization to a phase where globalization basically peaked and moved sideways the last 5 to 10 years, and now we're heading into deglobalization. And I think that's hugely disruptive, and we're only beginning to see the impact of this, right? I mean, companies are only starting to change their supply chains and the value chains, and these chains have been widening, they've been lengthening for a long time. Now they are narrowing. Companies will start to bring their suppliers closer to home, and all of that means, we are becoming less efficient. The global system is becoming less efficient, and it actually destroys a lot of capital that has been invested.
Mm-hmm. On supply chains, it's an issue we've discussed a lot with our members. Everyone's talking about it. I can totally see the potential for these supply chains to change completely in a few years, because this is not looking great. But when it comes to markets today, your clients, people you talk to, are things already changing? Do we have evidence that things are already changing, or maybe a few people are waiting until November next year to see if maybe things go in a different direction? How do you feel? I mean, and that's to the panel, not just Joachim.
I'm happy to start. I think, Pascal, you touched on this very briefly earlier. Even though you can see the US stock market and global stock markets near all-time highs, if you take it sector by sector, you can see that people are incredibly concerned. So you have a huge discrepancy in valuations and also returns between so-called defensive equities and more aggressive cyclical equities. So the valuation of a water utility, for example, is probably triple the valuation today of the S&P 500. And that's fear. That's people saying, well, I run a balanced portfolio. I need to have some stocks in my portfolio, but I want the most protective, defensive, let me sleep at night stocks I can get. And so that's where you've seen it under the hood. So money going into equities, not all, but a lot of it has been going to those areas. I worry that even if we get a truce on the trade deal, it doesn't change the election in the United States into 2020. I think because there is a perception that you could have a continuation of what we have now, which might be some tax cuts and deregulation, but also potentially a lot of day-to-day uncertainty. Or you could have a new administration, but there's uncertainty with that because you don't know what kind of policies could come. It's a reason why this sort of investment strategy won't change near term, and back to growth, why CapEx and corporate decision-making will probably be pulled in a little more limited, not just now for a trade truce, but even going further.
Yeah, and actually, if I can add to that as well, I mean, the data that we have shows there was a collapse, obviously, in cross-border investment in 2018. So the first reaction has been put the brakes on in terms of those cross-border flows. And the risk is that, yes, I mean, companies want to shift their supply chains, and certain countries are already delivering policies to encourage that to happen. You've seen some policy developments, for instance, in Taiwan to encourage some of the investment to come back from China, particularly some of the products that are due to get tariffs imposed on them in December, areas of laptops and such like. So government policy is responding to almost encourage some of these supply chain developments. And we've seen some adjustments regarding Vietnam, which then got subjected to US tariffs as well for the process of trying to circumvent it. So, and I think that's what companies are trying to grapple with. It's kind of, do I quickly take a decision, or do I wait to see how the land is lying? And also, what are the trade liberalization developments happening elsewhere? When we are seeing deglobalization, but we're almost seeing a re-acceleration of regional and bilateral trade deals. You know, we're seeing it by Europe very quickly, getting the trade deal after 7 years with Canada, after the Brexit vote, and then with Japan, and then with Singapore and Vietnam, and maybe even with Mercosur. We'll see how that one goes. But, you know, and we're seeing the, you know, other countries as well. So you're getting new areas. I completely agree that it's not going to be as good for global welfare and efficiency, but the rest of the world isn't standing still. They're looking for new linkages. And that's what companies are waiting to respond to as well.
Yep.
Well, yeah, to remember, on trade, actually, the rosy view is that there is clearly an interest politically for Mr. Trump to secure a deal before the election, but who knows. But to stop in mind on trade is what could be the implication next year, moving into next year in the foreign exchange markets, actually, because we have not yet seen what could happen on the currency side. Regarding your question, we are seeing an ongoing repricing in the markets away from, I would say, global trade and in favor of, as I mentioned, what is closer to internal demand engines, services on the ground, domestic type of structures. And specifically in the emerging market economies, to give you some examples, compared with, let's say, 10 years ago, I prefer now to be exposed to the ascendancy of services in China or infrastructure in the Philippines or the internal demand in Indonesia or India than to the typical global exporter of the last 2 decades.
Mm-hmm. Perfect. We have very little time left, so I'm not going to try to get another question in. If you have any final thoughts on that, go for it. If not, we'll wrap up. We do have a lot more interesting stuff that is coming in, but we'll have to leave it for another time. Thank you, everyone, for being here. I know it's a long conference, so we're very happy that you were here with us. You had many options right now, so we're very happy you chose to listen to us. Panelists, you did a great job, and we look forward to having you on stage again soon. Thank you.
Thank you. Thank you.